As of 9:58 a.m. Eastern Time on October 29, 2025, Bitfarms, ticker BITF, is trading live at $4.38, representing an intraday gain of 1.86% or about 8 cents per share. The stock opened the session at $4.28 and has already shown significant volatility, trading in a range between $4.18 and $4.67 on volume of just over 7 million shares. This is the kind of action that has drawn so many eyes to this name, but the immediate assumption, the broad market expectation, is that this is just another Bitcoin miner. The common belief is that Bitfarms is a simple, leveraged proxy for the price of Bitcoin itself. You buy it, Bitcoin rips, and you make even more. And with the stock having posted a staggering 428% run in just 3 months recently, that expectation seems to be confirmed. But this is where the expectation falls short, and the reality of what is happening under the hood of this company becomes so much more complex. The market is pricing a volatile commodity producer, but it is missing the signs of a company in the midst of a massive, funded, and strategic transformation. This isn't just a miner anymore. It's an attempt at building a diversified American infrastructure company. Most investors, especially those doing self-investing on platforms like the Robinhood app or SoFi Invest, see the daily swings in BITF and treat it as a trading vehicle. They watch the price of Bitcoin, they watch the Tesla stock chart for momentum, and they jump in and out. The narrative is simple. It's all about the crypto price. But the deeper story, the one that professional asset managers and those building long-term accounts with Fidelity or Schwab Intelligent Portfolios are analyzing, is one of radical corporate change. What we are witnessing is not just growth, but a complete strategic pivot. In the first quarter of this year, Bitfarms closed what it called a transformative acquisition of Stronghold Digital Mining. This was, by their measure, the largest merger and acquisition deal between two public miners in the industry's history. But this wasn't just an addition, it was part of a rebalancing. At the same time, the company was finalizing the sale of its 200-megawatt Yguazú data center in Paraguay, and just this August, announced a full exit from its Argentina operations at the Rio Cuarto data center, citing a prolonged power supply disruption. This is a clear and deliberate consolidation away from less stable international jurisdictions and a powerful pivot directly into the United States. This U.S. pivot is the entire story right now. The company has stated that over 80% of its multi-year development pipeline is now concentrated in the U.S. They've acquired land in Pennsylvania, specifically the Panther Creek location, and in Washington state. And here is the critical part. This land is not just for mining Bitcoin. Bitfarms is aggressively moving into the high-demand, high-margin world of high-performance computing, or HPC, and AI data centers. This isn't just a plan on a slide deck, it is funded. The company secured a private debt facility for up to $300 million from a division of Macquarie Group, one of the world's largest and most respected infrastructure investors. This is a massive vote of confidence from a serious institution. And importantly for current shareholders, this is a debt facility, not a dilutive equity offering. They are funding this new venture without printing millions of new shares, which shows a level of financial discipline that is often absent in this sector. They are hiring for it too, appointing a new senior vice president of HPC and AI, and an SVP of infrastructure. To de-risk the technical side, they've partnered with T5 Data Centers, a known leader in data center architecture. Because building a facility for AI clients, with its intense liquid cooling and high-density demands, is a completely different ballgame than a standard crypto mining shed. Of course, the legacy business, the Bitcoin mining, is still the engine paying the bills, and that engine is still growing. As of their last operational update, the company had an operational hash rate of 19.5 exahash per second, a 21% jump in a single month. They also hit their fleet efficiency target of 19 watts per terahash, 3 months ahead of schedule. This is the part of the business that active traders on Interactive Brokers watch. But the financials from this engine show why the pivot is so necessary. In the first quarter of 2025, Bitfarms reported revenue of $67 million, a solid 33% year-over-year increase. However, the gross mining margin fell significantly from 63% in the first quarter of 2024 down to 43%. This signals rising costs and pressure on the core business. The company posted a net loss of $36 million for the quarter. The most critical number in the report was the cost of production. In Q1, their direct cost to mine 1 Bitcoin was $48,700, and their total cash cost was $72,300. With Bitcoin trading around $82,000 at the end of March, the margins were there, but they were not massive. This highlights the risk. Bitfarms needs a high Bitcoin price to maintain comfortable profitability from its mining operations, which explains the strategic urgency to develop a new non-correlated revenue stream from AI and HPC. This is where the company's balance sheet becomes a core part of the thesis. Despite the net loss, their financial position is surprisingly strong. As of mid-May, the company had total liquidity of $150 million. Its current ratio, a measure of its ability to pay short-term bills, was 3.11, which is significantly healthier than the industry average. Even more impressive is the debt. While they just took on the ability to draw $300 million from Macquarie for their new projects, their existing debt load is tiny. The company's total debt-to-equity ratio is a mere 7.8% compared to an industry benchmark of 57.4%. This financial prudence gives them a long runway and the flexibility to execute this complex pivot without being at the mercy of the capital markets. This is not a company that will be forced into a dilutive raise tomorrow. It also employs a different treasury strategy than its peers. Bitfarms is not a HODL company. It sells the Bitcoin it mines. As of March 31st, it held 1,140 BTC, valued at over $93 million at the time, but it uses those sales to fund its capital expenditures and operations. This makes it less of a pure play on a rising Bitcoin treasury and more of an operating business that uses Bitcoin as its product. This is a key distinction for anyone considering an investment in this name versus simply buying a spot ETF. The institutional ownership report confirms that this complex story has attracted serious capital. 176 institutions are on the books, holding over 124 million shares. The names on the list are not fly-by-night funds. We're talking about Invesco, VanEck, and the Royal Bank of Canada. More specifically, we see significant holdings from major thematic ETFs. The Valkyrie Bitcoin Miners ETF is a top holder. But look closer and you'll find Fidelity Investments is involved. Their Fidelity Crypto Industry and Digital Payments ETF, FDIG, holds nearly 3 million shares. Charles Schwab is in too, with its Schwab Crypto Thematic ETF, STCE, holding almost 4 million shares. This isn't just retail speculation. Fidelity brokerage accounts and Fidelity wealth management clients are getting exposure. This is smart money placing a bet that the company can pull off this transition. But this is also where the tension comes back, because for every bull, there is a bear. The short interest in Bitfarms is sitting at 9.79% of the float. That is a significant number of shares betting that the price will fall. The off-exchange short volume ratio has been high, recently hitting 34%. This indicates a fierce battle between those who believe in the HPC pivot and those who see an overhyped miner that's losing money. This brings us to the future outlook and the wild disconnect between the stock's recent performance and Wall Street's expectations. Analysts at firms like Jones Trading and ATB Capital have buy and outperform ratings. They see the potential. Yet the consensus one-year analyst price target is just $2.55. Let me repeat that. $2.55. With the stock currently trading at $4.38, the official analyst consensus implies a massive downside, suggesting the 428% run was pure hype that got way ahead of the fundamentals. This is the expectation versus reality conflict in its starkest form.